A private equity fund receives $12 million from an exit. What is the realized gain? 12 million? Wrong. 1 million? Still incomplete. The total realized gain is $4 million. But the current period increase is only 1 million. How can both numbers be correct? This one example reveals whether someone understands private equity exit accounting or is only following the cash. Let's follow the transaction from the beginning. The fund invests $8 million in a portfolio company. At acquisition, the simplified entry is debit investment in portfolio company 8 million, credit bank 8 million. The original cost is 8 million. Now move to the previous reporting date. The portfolio company has performed well, so the fund marks the investment from 8 million to $11 million. That creates $3 million of unrealized appreciation. The simplified valuation entry is debit investment in portfolio company 3 million, credit unrealized gain 3 million. The investment is now carried at 11 million. The fund's NAV has already increased by 3 million, even though no sale has happened and no exit cash has been received. That point is critical. The 3 million gain is not new on the exit date. It was already reported in earlier periods as unrealized appreciation. Now the fund sells the investment for $12 million. We now have three numbers. Original cost 8 million, previous carrying value 11 million, exit proceeds 12 million. Each answers a different question. 8 million is what the fund originally invested. 11 million is what the books already reflected before the sale. 12 million is the cash paid by the buyer. Now calculate the total realized gain from original cost. 12 million of proceeds minus 8 million of cost equals $4 million. So why is the current period increase only 1 million? Because 3 million of the gain was already recognized earlier as unrealized. The investment entered the period at 11 million and exited at 12 million. That is only 1 million of new value in the current period. But after the sale, the full 4 million gain from original cost must be classified as realized. This is where candidates mix up four different concepts: cash receipt, original cost, carrying value, and current period profit. The 12 million is exit proceeds. The 4 million is total realized gain from cost. The 3 million is previously recognized unrealized appreciation. And the 1 million is the additional uplift since the last valuation. All four numbers are correct. They are simply measuring different parts of the same exit. Now comes the journal entry trap. If you remove the investment at its original 8 million cost and record a 4 million realized gain, what happens to the 3 million of unrealized appreciation already sitting in the books? But if you remove the investment at its 11 million carrying value and record only 1 million of gain, how will reporting show a total realized gain of 4 million? That is why an exit cannot be understood through one debit and credit alone. You must record the cash, remove the investment, reverse the previously recognized unrealized appreciation, and present the full gain from cost as realized, without counting the same profit twice. So what are the entries? And what happens next when the fund distributes the cash to its LPs? That is where part 2 begins. Journal entry trap. The exact account names and system postings can vary by fund, accounting framework, and chart of accounts. But the economic logic must remain consistent. At the sale date, the fund receives $12 million, while the investment is carried at 11 million. A simplified entry is debit bank 12 million, credit investment in portfolio company 11 million, credit realized gain 1 million. That records the 1 million increase from the previous carrying value to the sale price. But the exit is not complete. $3 million of appreciation was recognized in earlier periods as unrealized. Now that the investment has been sold, that amount must move from unrealized to realized. Conceptually, debit change in unrealized appreciation 3 million, credit realized gain 3 million. After both steps, total realized gain is 4 million. Unrealized appreciation reverses by 3 million and the net current period increase remains 1 million. 4 million of realized gain minus the 3 million unrealized reversal equals 1 million of current period profit. This reclassification prevents double counting. If you record the full 4 million realized gain but do not reverse the earlier 3 million unrealized gain, profit and NAV are overstated. Now comes the second trap. Exit proceeds are not the same as a distribution. The 12 million first enters the fund's bank account from the buyer. That is the investment exit. The fund may retain cash for transaction expenses, liabilities, escrow, reserves, or follow-on obligations. Only after applying the fund documents and waterfall does the fund distribute cash to investors. A simplified distribution entry may be debit, capital distributions, or the relevant partner distribution account, credit, bank. This is a separate event. The exit creates cash and realizes performance. The distribution transfers cash from the fund to its partners. The dates can differ, the amounts can differ. Now ask the question interviewers really care about. What reaches the LP statement? Assume the opening capital already reflects the investment at 11 million fair value. After the exit, the statement may show realized gain plus 4 million, change in unrealized appreciation minus 3 million, net current period investment gain plus 1 million, and separately any cash distribution allocated to the LP. Performance activity explains how value changed. Capital activity explains how cash moved between the investor and the fund. So even if 12 million is distributed, that does not mean 12 million of profit. In this simplified example, 8 million represents recovery of original cost and 4 million represents total economic gain. That gain may then be allocated between LPs and the GP based on the waterfall, preferred return, catch-up and carried interest terms. Now consider DPI. DPI compares cumulative distributions with paid-in capital. The distribution affects DPI. The realized gain alone does not. Cash must actually be distributed before it enters the numerator, subject to the fund's reporting conventions and treatment of recallable amounts. Two senior level complications can change the numbers further. First, a partial exit. If only part of the investment is sold, do not remove the full cost or reverse the full unrealized appreciation. Allocate the appropriate cost basis and prior unrealized amount to the portion sold. The unsold portion remains on the books at its updated fair value. Second, headline sale price may not equal immediately available cash. Escrow, holdbacks, transaction costs, and contingent consideration can create receivables, reserves, or later true-ups. So the legal sale price, cash received at closing, and cash distributed to investors may all be different. Now, if the interviewer asks, what is the difference between exit proceeds and realized gain? Here is the strong answer. Exit proceeds are the consideration received from the buyer. Realized gain is the difference between those proceeds and the cost basis allocated to the investment or portion sold. Any previously recognized unrealized appreciation must be reversed or reclassified when the investment becomes realized. And any later distribution to investors is a separate capital event governed by the LPA and the waterfall. That answer follows one exit from the portfolio company, to the fund's books, to NAV, to the investor capital account, and finally to the LP statement. That is what the interview is testing. Not whether you memorized one entry, but whether you can follow the money, separate performance from cash movement, and explain what changes at every stage. For more practical private equity and fund accounting explainers, subscribe to the Fund Desk.